We have all been in traffic jams, especially if maybe you're in a traffic jam every day if you commute to and fro to work, but we've all been in a traffic jam. And the interesting thing about a traffic jam is what happens with the brain while we're in it. And think about this. I mean, most people are in traffic jams every day, and yet their brain kind of freaks out while they're in it. I mean, mostly, even if someone says they're calm, probably unconsciously there's a stress in being in that traffic jam. But for someone that's in a traffic jam and they're getting stressed out, even if they're late, in order to be stressed out in a traffic jam, you have to lose perspective, right? You have to think you can do something different and switch lanes, and lane switching actually doesn't help. But we kind of lose perspective. And if we're able to kind of move above the traffic, so there's two main highways that run through Silicon Valley, Highway 101 and Highway 280. And by the way, no one says Highway 101. They say the 101 or the 280. But if you were in a traffic jam on the 101 and you just moved above it a quarter mile so you could see the jam above and, in front of you and behind you, you'd actually start to calm down. It would give you perspective. It would have you say, look, I can freak out in the car, but this is not going to, loosen up or ease up until I get around that turn. And that turn is 3 miles ahead. So I might as well just relax. And so if you were in a helicopter or you were able to magically put yourself a quarter mile above the traffic, you would have a different view. Again, even if you were late. And I find this point of view or this idea, this metaphor, really important to growing your money, protecting your money in the stock market. Hey, everybody, this is RC Peck, and this is my weekend podcast. It's actually episode 335. So good to have you here. And the theme for this weekend is perspective. So I'm showing you a galaxy here. Literally, there are hundreds of billions of galaxies. This one has a weird name like CD3052. But I just think when we have perspective, and wow, what a perspective we can have then looking down at a galaxy, while in that galaxy there's hundreds of billions of stars, it can give us perspective. And so what I want to do is give perspective. And one of the best things I do to get perspective is to look at relative charts, meaning how is one index doing against or relative to another index? How is this stock doing relative to the sector it is in? And having this relative point of view can give you that insight that I think a lot of people are looking for. Because much too often we're just told, buy the sector, buy the stock, buy the asset class. Why? Well, you got to diversify. Oh, yeah, okay. I mean, we don't even question diversification. And yet diversification is pushed upon us by the people, and even the people who are pushing it upon us don't really even know if it's something that should be done, but they're doing it. So we get pushed on this idea of diversification and complexity. And for what reason? Really, do we really need to be in international stocks? Why? Oh, you got to be diversified. But it's complete garbage. So I want to show you this first price chart. It's a price chart comparing the European stock market against the United States stock market, specifically the S&P 500. If you see the line falling, that means the S&P 500 is growing stronger, is acting stronger and being stronger than the European stock market. And as you can see over this last 3 years-ish, the U.S., or the S&P 500, let's just call that the United States or the U.S. stock market, has been outperforming. Now, we know it's outperforming because if this price chart was going higher, that would tell us that the European stock market is doing well. So yes, between mid-2013 to the end of 2013, maybe for 4 months, the European stock market did well. You can see that here. If you have a view of the screen, you can see how the European stock market was outrunning the U.S. stock market. But then it just went sideways for a while, which meant they were kind of performing exactly the same. And then from, call it May of 2014, 2 years ago, the U.S. stock market has been performing so much better than, I think I said the U.S. stock market. The U.S. stock market has been performing so much better than the European stock market. And one of the reasons I put this on here, well, there's a few reasons, but one, look at this big drop down here today. That actually made new lows. over the last 3+ years. So even though the S&P was down on Friday and the European stock market was down, the fact that the US was down a lot less than Europe is the reason why you see this line dropping as much as it is. And this is one of the reasons why I rail against diversification, because there are people out there that say, no, you have to be diversified internationally. You got to have some international diversification. But it's total garbage, because look at this price chart. If you would have had your money allocated to Europe over the last 2 years, it would have slowed down the growth of your money. It would have made your future less secure. It would have gone against every reason why you are investing your money anyway. And this is what relative charts can do. It gives you that perspective that, being a quarter mile, be a mile above the traffic, have that perspective. And as you can clearly see here, Europe is accelerating to the downside. In this case, against the S&P 500, but that's not good. And so anyone who has I'm doing air quotes right now, a well-diversified portfolio with international stocks in it, or in this case, European stocks, you really have to question why you're doing that. What beliefs are you believing in? Why are you aligning your money to your beliefs? Don't align your money to your beliefs. Align your money to the market. That's what's going to grow and protect your money. The second price chart I wanted to show you is emerging markets. So this is comparing the emerging market asset class or sector against the United States or the S&P 500. And again, if the line is falling, which it has been for 3.5 years, that means emerging markets are doing worse than the S&P 500. Now, if you look just here in 2016, there is a little bit of an up move, right? But generally speaking, as you have perspective and you step back and you look, that blue line is the 70-day exponential moving average. So when you look at that, you say, yeah, okay, maybe it is going up. It has been doing well, but then it really got hurt. And when you zoom back, you go, yeah, I don't really know if I should be having any of my money in the emerging markets, because the price charts, which you're now learning you want your money aligned to, are telling you to wait. They're telling you to wait. Like, look, maybe you do want your money in emerging markets, but wait until it starts beating the S&P, and it's not. And I get that if you would have gotten in here and saw this, said, hey, it's starting to beat, that's fine. And until this line breaks below, until it breaks below the low in 2016, in which it has to first break below the May low, it's basically telling you the S&P is still the strong sector. And this is just another reason why I like relative price charts. Immediately you can tell what's working and what's not working. And there's this belief out there, and people align their money to this belief that you should have your money diversified. And one of the main places big box and independent and boutique advisors and even pick of the month newsletters, editors, and weekend workshops, they say you got to have some international exposure. Why? You got to be diversified. Why? Because it's safer. Show me, prove it to me, show me where it's safer. And when I talk about railing and going against diversification, I'm not talking about putting 100% of your money in Walmart or one individual stock. Yeah, I get that can really, really work out or really, really not work out. And all things being equal, you never want to be in an investment where it's either going to really, really work out for you or really, really not work out for you. Now, I got one more price chart I want to show you. And this price chart is not about location, but it's actually about a type of stock. And what you see here is still, you see a relative price chart. So in this case, we're comparing big, safe, dividend-producing stocks of the S&P 500 to the actual S&P 500. So in 2013 and in 2014 and pretty much in 2015, those 3 years, the S&P 500 was performing much better than large, safe, dividend-producing companies like Procter & Gamble and Johnson & Johnson. But you can see since the end of 2015, those safe dividend-producing stocks relative to the S&P 500 have been killing and crushing the returns of the S&P 500. This is one of the reasons why relative price charts are so important. They can tell you, relatively speaking, which asset, which location in the world, which type, which size of stocks are doing best. And it can save you hours or tens of hours or hundreds of hours of research. You just pull up a price chart and be like, yeah, dividend producing stocks are crushing it. That's where money is flowing. We know money is flowing into there. And I've talked about this before. Why I think money is flowing in there is because the S&P 500, the U.S. stock market's gone sideways for 2 years. And people are getting concerned. People are getting scared. You have 10,000 baby boomers retiring each day. And they're saying, hey, if I got to be in the stock market, well, then guess what? I'm going to be in the safest ones that produce the best dividends. Even if I don't like Philip Morris or Altria, I'm going to buy those because they are safe, they produce dividends, and they're going to be around in 50 years. Here's the takeaway, guys. Diversification is a 1950s idea that needs to be put to rest. I get that it was a good idea if people were putting all their money in like 2 individual stocks, but that's just dangerous. That's, I get that you want to spread your risk out, okay? The diversification I'm talking about that I rail against is getting 10 different asset classes and rebalancing them once a year. That is an approach that has not worked for a long time. And all it takes is someone to look at a handful of price charts over a 5-minute period to know that diversification is an idea that has long run its course. And it's actually one of the things that is hurting people because it keeps their money in the market way, way longer than it ever should be. Now, instead of diversification, I think you should align your money to the market. I don't think you should align your money to your beliefs or your financial religion, or even your age or your risk tolerance. I think you should align it to what the market is doing. Secondly, probability. What's the probability? I'm just going to quickly go back to one of these. Like, what's the probability of this line continuing to fall, the emerging market being compared to the US? The probability is more in the favor that it keeps falling because it is very hard to change the direction of anything. I mean, Newton figured that out. Something in motion needs something with equal and opposite force to push against it to have it move direction. So you want to look for the probability, not the diversification. And lastly, guys, we're all trend followers. Everybody who's invested in the stock market is trend followers. If you're a buy and holder, well, guess what? Guess what the biggest trend over the last 120 years is? Yeah, it's the stock market going up. You're a trend follower by default. If you've been in bonds for 35 years, you're a trend follower because bonds have been going up for 35 years. We're all trend followers. Now, the question is, what's that time frame of your trend following? Are you trend following for a day, an hour, 10 minutes, or 30 years? And what I've noticed is either end of that spectrum, you trend follow for 30 years or you trend follow for 30 minutes, are equally dangerous. You want to be somewhere in between where you can see where your money should be aligned, where you know the probability of something going up or something going down or something continuing. That's what's going to help you the most protect and grow your money in this market and in any market. Hey guys, this is just another step in helping you protect and grow your portfolio and your future. Until next time, this is RC Peck. Hey guys, I want to let you know about my Get a Second Opinion service. It's one of the things I love doing. This is where I sit down with someone. I metaphorically sit down with them because we do this over the phone. But people oftentimes get second opinions when, say, they are in the hospital or something is wrong with their body. But it's interesting how rarely people get a second opinion when they are talking about their finances or their investing. And so one of the things that people have been loving is getting that third-party point of view to sit down and say, okay, this is what I'm doing, or this is what my advisor and broker is doing. Where are the leaks? Where are the holes in the hull of my portfolio? And what can I do to patch them? Like, where am I losing the money? That's just like, where am I losing the money? Then it is, what can you be doing more effectively so that money stays with you and grows your money and protects your future? The other thing I want to point out, and this is something new that I've been doing, and it's pretty interesting. I don't know if you know this or not, but Social Security has Social Security has 2,728 rules in its handbook covering retirement benefits, spousal benefits, child benefits, disabled child benefits, widow or widower benefits, child and care spousal benefits. You didn't think there were this many benefits. Mother benefits, father benefits, divorced spousal benefits, divorced widow benefits, or divorced widower benefits, or divorced mother benefits, or divorced father benefits, or disability benefits, or parent benefits. The point is, 10,000 baby boomers are retiring every day. They don't know what their rights are. And I just said, and I'll say the number again, there are 2,728 rules in Social Security's handbook on benefits, right? I mean, just putting all the programming together of how those all fit together, there's literally hundreds of thousands of rules that come with those set 2,728 rules. And the potential benefit and differences is very different. And so one of the things I do with people who are moving into retirement or looking at their benefits is to do a screen on their benefits to see if, in fact, they're getting everything they can from Social Security. That is their right to get, not just calling up the government, because a lot of times the government doesn't themselves, they don't know. The person on the other end of the phone, they don't know. But it's just something that my clients love so they can maximize their Social Security benefits. And even if you're in your 50s or your 40s or you're nowhere near, having that second opinion, having that set of eyes and looking, going, where can we shave the costs? Where can we cut the expenses? Where can we eliminate the problems and identify the biggest gap? That's what you get in a second opinion. Parts of you may be curious, and when you are, you can just go ahead and reach out to Patty, either just by calling her with the phone number on the screen, the 650 number, or just emailing her and saying, I'd like to get a second opinion with RC. Thanks, everybody, for being in my world. You guys have a great weekend, and I will speak to you soon.